It was somewhat of a quieter day on Wall Street here today, but don't let that fool you. There was still plenty to talk about in tonight's video. I want to talk about ARK. Yes, we're starting to see some positive movement out of ARK for once. We're starting to see some of the more speculative investments catch a bid. At the exact same time, we're seeing some of the quiet, so-called safer consumer staple stocks get absolutely trashed in the last couple of days. So we're going to see what that movement has meant, not only just for those sectors, but also for our posture of the markets at large. We do have a major difference taking place on our foregrid here tonight that I'm going to discuss with you in tonight's video. And then we're going to get into our trade application example, where I wanted to focus on a dividend aristocrat that I'm a long-term fan of. However, in the short term, we're starting to see a breakdown on the chart, and I wanted to take advantage of that with a bearish trade setup. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 19th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below. Make sure you're signed up for our email distribution list, which you can find in the description area. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee. We really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, it's a bit of a mixed bag here today. Obviously, we've been having some extremely one-sided types of days here recently, so this is maybe a chance for a good change of pace for us to kind of catch our breath a little bit here. But as always, there's some interesting movers out there. Of course, this is a big earnings week for retailers. Some of you saw what happened to Target yesterday, immediately after what had happened to Walmart the day before. In fact, some of you might have seen my tweet that I posted about that this morning. So if you're interested in some of the statistics around that and just how terrible it was, perhaps one of the worst 48 hours in the history of big box retail, where if you were to look back at the biggest drawdowns, one-day drawdowns for Target and Walmart, the second worst days since 1987 happened to both of these this week. So in the case of Target, of course, that was yesterday, and they were down 25%, which is the worst day since 1985, with the only exception being Black Monday of 1987, when the entire stock market was down more than 20% in a single day. So other than that crazy anomaly of Black Monday, yesterday was the worst day for Target since 1985. For Walmart, it wasn't quite as bad on a percentage basis. However, remember, Walmart has a market cap that's about 3 or 4 times larger than Target. So from a total dollars lost perspective, it was also quite devastating the day before yesterday, and it was down 11%, which again, outside of that weekend of the chaos in 1987, that would have been the worst day for Walmart since 1985. So to have that happen back-to-back days is basically unheard of. And so that was kind of the bomb that was dropped on the markets here in the last couple of days, and it kind of had a change of feel for the market as well. As we head back on over here to the heat map for today, you'll notice that a lot of these consumer-oriented names were down significantly, including Walmart once again, and including Target once again. They were both down again today. We also saw Coca-Cola down again today. We saw Procter & Gamble down again today. Both of those, by the way, were down more than 6% yesterday, which all by itself is actually quite rare, especially when there was no company-specific news around it. So if you had anything to do with consumer yesterday, you got absolutely hit hard, and today didn't really do you any favors in terms of any possible snapback type of a rally for the most part. Some of the consumer discretionary names were able to bounce back a bit today, but the consumer staples still in the house of pain, and that is unfortunate on many counts. First of all, I always have to get a kick out of the market serving up its regular helping of humble pie. You guys were just hearing me talk about a couple of days ago how how well all of my trades were going, and wouldn't you know, the very next day is when Target drops the bomb, and the trade that I had done on Constellation gets stopped out immediately. So go figure. The market is certainly good at one thing, and that is humbling its practitioners, myself included. But in addition to that, many of you know that I am a dividend growth investor personally. And so my biggest sector from a personal perspective is the consumer staples. So whenever they are getting beat up like they have in the last couple of days, understand that I am going to be under more pressure than other folks as a result of that. But I also acknowledge that those consumer staples did hold up much better than most of the other sectors up until the last couple of days. So I am thankful for that at the same time. But, going back to the comment that I made a second ago, where it kind of felt like a sea change of sorts, it kind of feels like now they're going after the aristocrats, right? Now this market has entered into kind of a new stage where it was at one time taking out the lower quality companies that were kind of speculative, that didn't have any profits, that sort of thing, and they were taking them out back and beating them. Now they've kind of made their way into those big, bulky, blue chip Dow Jones types of companies as well. So not a great feeling there that this is a market that is finding fewer and fewer places to hide out if you want to be on the long side of the market. So naturally, there are other opportunities out there, including bearish trades. ETFs like commodities are still holding up, and there's a handful of things that might work out there, but it's definitely getting much more difficult than it had been previously. So it just goes to show that our bearish postures that we've had here recently, we're kind of trying to clue us in on the fact that yes, we're not out of this yet. The other thing that, of course, we've been talking about here more recently is there hasn't been this really big capitulation type of an event yet. So in a way, today's action, while it might have felt good because there wasn't chaos like we've been experiencing here lately, it's actually not really what you want to see if you want a bottom to be placed. What you want is extreme chaos that basically flushes everybody out of the system. Many participants throw their hands up in the air and liquidate their accounts and give up on the markets. And it's that type of kind of behavior en masse that could eventually create a bottom, and a workable bottom with a constructive activity. You've heard me mention that we're waiting for those long lower shadows where we kind of flush everybody out of the system and then have the market rally back furiously by the end of the day. And we just haven't seen that type of a day yet, and we still haven't seen the VIX spike up to 40 yet. We're still stuck in the 20 to 30 range in the VIX. So while this has felt really terrible for a lot of folks, it's more akin to death by 1,000 paper cuts. This is not a complete massacre all at once like a lot of bottoms throughout history have been formed. So I wish I had better news for you on that count, but if we were to rally from this moment going forward, which remember is a possibility, we are certainly oversold in the short term. So bouncing back towards those falling 30-day moving averages is something that I'm still expecting. Whether it happens or not is anybody's guess, but that is where my expectations are. However, if we do not get a major flush out before that happens, then I'm going to be even more emboldened in my opinion that the markets are more likely than not going to fail in that rally attempt, and they're going to roll over once again. Whereas if there was some sort of a cataclysmic type of a whoosh, right? We're down about 19% on the S&P 500 right now. We're down about 29% on the NASDAQ. So if we had some sort of a day where we were down like 5% in a day, and then, in the last couple of hours of that session, we rallied all the way back up to break even. It wouldn't even have to be a day where we were up significantly. If we could just make up for a massive loss on an intraday basis, that might give me the impression that we've got, enough constructive bottoming type of behavior and psychology and sentiment and all these other things that go into it, where that could be a workable bottom. But until we get a day like that, I'm just going to make the assumption that we're going to have to struggle here in coming months and perhaps as much as a year. Remember, the typical bear market is not something that just quickly ends. The average bear market throughout history is usually something around like 18 months. And, with the NASDAQ, we topped out maybe about 6 months ago. But with the S&P 500, it was just here in January. So that kind of gives you a sense of, if we are in the midst of a bear market right now, how far along we've come, and where the average time period would take us is still probably another year of this type of behavior. Now remember, we do have a political cycle to think about here as well as we head towards the midterms. The midterms will be this fall here in the United States, and that has the possibility of having, politics play a role in the financial markets, where a lot of people who are in power want to stay in power, and therefore they will maybe enact certain things that can kind of juice the spirits of the market. I'm not saying that will happen. I'm just saying that that is the way that we think generally about these midterm types of years. So it's possible that we find some sort of a short-term bottom here in the summer, and we rally towards the midterm elections in the fall, and then we break down violently again in the stock market in 2023 before it's all truly ended, and we can kind of move on with kind of a new opportunity for folks. So we'll see how it all plays out. Obviously, every day gives us an opportunity to learn and adjust our thinking if necessary, if new information emerges. But those are just some of my basic thoughts off the cuff there. In terms of any bigger movers we had today, you can see that Cisco was one of the worst performers in the market today. In fact, I think it was second worst only to Under Armour. Under Armour was slightly worse than it here today. Cisco, unfortunately, is a company that we kind of got a buzzsaw on because we actually had sold puts on it in one of my classes. Has not breached our strike yet, so I don't want to sound the panic alarm on that, but it still was not a great look to see that particular stock down 13% here today. On the flip side, I also have to remind myself that, hey, we also caught the best performer in the S&P 500 today. This ticker symbol SNPS is one of our current holdings in my top-down trend trading class. In fact, it's in what we call our coffee can portion of our portfolio, where once a stock has doubled in that trend trading class, we sell half of our shares, extract our original cost basis, and then play with the house's money on the remaining shares. And Synapsys is one of those companies that can kind of make it into our trophy case, so to speak. So we were pleased to see that that was the leading stock in the S&P 500 today, up over 10%. But as you can see, it really wasn't much in the way of patterns. I would say that staples were clearly underperformers. There was a consistent red theme throughout the consumer staples. In terms of any consistent bullishness, I'm not really sure it exists. You probably had a bit more bullishness there in healthcare and maybe a bit more bullishness in consumer discretionary. Let's go ahead and pop on over to the main part of the platform now. Take a quick look at market breadth. And as you can see, 222 stocks in the S&P 500 are up here today. And so by my math, that is approximately 45%. So, we had basically a split decision today. It really wasn't an aggressive up or down day. Yes, the market closed a little bit lower for the S&P 500, but it wasn't one of those washout types of days where you had like 90% of the constituents down. This was more of a even keel type of a day, so not much to report there. Back on over here to the main charts now. This is our 4 grid right here. And this is chart 4B for those of you that are premium members that are following along with your own charting package that we give you as part of your premium membership here at Market Scholars. And this 4 grid will show us the 4 major U.S. equity indices and give us a sense of what the posture is according to the market forecast technical indicator. The market forecast technical indicator is that indicator you see below each of those 4 charts there. And as you can see, not much has changed in the last couple days. In fact, I was going to mention this as well. Those of you that watched my video on Tuesday heard me say there's a pretty decent chance that some of our postures will go to bullish as long as there's not some sort of a massacre in the market the next day. Whoops. I guess that one you can rest squarely on my shoulders because the trading gods must have been listening. We had a massacre yesterday, so wouldn't you know that we were on the verge of going to a weekly bullish posture. All we really had to do was hold the line. Even if we would have gone down just a little bit yesterday, I think we would have probably gone to bullish postures. But instead, there was a massacre yesterday, and so it did keep that green line in the lower reversal zone on most of these charts. You can see that the exception to that was the Russell 2000, so the chart in the lower right-hand corner here. Notice that it did end up going to a weekly bullish posture yesterday, despite its somewhat aggressive candle there yesterday. And I think that's probably a good place to start with our conversation here tonight as well, because not only do you see that the Russell 2000 has the light green background color telling us that we've got a weekly bullish posture because this green line has now emerged out of the lower reversal zone, but you'll also notice that it was the outperformer today. So remember, yesterday was the day when the posture changed. Today was yet one more piece of information to tell us that the small cap Russell 2000 has started to show a little bit of relative strength. Notice that it was up 0.08% today. Now, that's not a huge move or anything like that, obviously, but it was the only one out of these four indices today that closed in the green. The other three all closed lower today. So one more piece of information there to let us know that, hey, there might be a little bit of a regime change taking place right now, and the small caps are starting to get a little bit more strength, and, that might be worth paying attention to. We just don't know where that sort of information will take us, right? It could end up being an important piece of the puzzle as we move forward. The other thing that I would mention as I look at all four of these charts is look at where the candle is today on the Russell 2000 versus where its recent low is. Here's our recent low on May 12th. Here's where we are today. Clearly, we are well higher than where we were trading a week ago. Now take a look at all the other charts. Here's the S&P 500, which is effectively right in line with its lowest candle. Technically, on this candle back here on the 12th, you did tick on an intraday basis a little bit lower, but today's close was actually lower than that day. So that's another important thing to point out, I suppose, is that this was the lowest close of the S&P 500 over the past year, even though on an intraday basis we went a little bit lower that day before closing a little bit higher. Take a look at the Dow Jones Industrial Average. Not only did we get the lowest close price of the year from a closing perspective, but we also tripped up a new intraday low. Notice the low tag is now below today's candle. You can also see on the label up above in pink there, it says yearly low today to give us an additional heads up about that. And then if you look down below here at the NASDAQ composite, it's somewhat similar to the S&P 500 where you're basically trading pretty close to where we were about a week ago. This one's showing a little bit more improvement, I would say there. But when we look at all three of those others, I would say that it is different than what we are looking at right now with the Russell 2000. There is more strength in the small cap Russell 2000 in the short term. Now we have to be careful taking that concept too far because obviously just because something is happening over a 1 or 2 week period does not necessarily mean that it can be applied to the next 2 or 3 months. Nonetheless, if there is going to be a regime change, it's got to start somewhere. And could this be the point where we do see a little bit of a shift in the investor mindset towards those small cap companies? We shall see. The other thing that I would point out that makes the Russell 2000 different than the others is that it's the only one that did not end today with an oversold cluster signal. It got awfully close, so it could have, depending on circumstances, but it just managed to avoid that fate. Remember, an oversold cluster signal occurs when you've got all three of the colored lines in the lower reversal zone at the same time. Here in these labels, it'll tell you where the current reading is for the market forecast various lines. And so the red line was just outside of the lower reversal zone. Anything above 20 is outside of the reversal zone. Near-term line was in it, so that one would have qualified as part of a potential cluster. But then the intermediate line was at 23. So 2 out of those 3 managed to close above 20. Now look at all of our other 3 charts on the board. The S&P 500 we have this nice little green dot right here and right here to help us identify that today was one of those oversold cluster signals. In fact, David was tweeting about this earlier today. For those of you that are not following David, make sure you're doing so. He does a remarkable job during these choppy and bearish markets, kind of sharing his thoughts on Twitter. And so in particular, now would be a great time, if you're not doing so, to follow David. You might follow me a bit more in the bullish markets, but David is somebody that you have to follow in the more bearish markets, because he is just filled with wisdom when it comes to helping navigate these more difficult periods like we're going through right now. But anyway, we did have that oversold cluster signal there on the S&P 500 and also on the Dow Jones Industrial Average and also on the NASDAQ Composite. So that's another way for us to kind of distinguish between these indices and ask ourselves, who is the leader, right? For a while, we were saying it was the Dow Jones that was the leader. That appears to no longer be the case. In fact, the Dow Jones may be getting the bears interested in its merchandise a little bit late, like it's trying to play catch up to the bears, right? And that kind of plays into that theme that I had talked about earlier, where they're gunning for the big blue chip companies like Coca-Cola and Procter & Gamble and Target and Walmart and those types of companies again. Of course, Target's not in the Dow Jones, but Walmart, Procter, and Coca-Cola are. And so if those are the types of companies that have just gotten waxed here lately, then it shouldn't be maybe a surprise to see that indeed we have a new low on the Dow on a day when none of the other major indices hit that low. So not a great sign there that they're now coming after the most high caliber blue chip types of companies out there as well. So you could get away with saying that the Dow is no longer our leader, and that has been now, the baton has been passed to the small cap Russell 2000. Remember, you can also read that in the labels themselves. So just by looking at the intermediate reading at 23, it is higher than the intermediate reading of the Dow now at 18, which is also higher than the S&P 500 at 17 and the NASDAQ Composite at 16. So from that perspective, it's yet another way to kind of determine, hey, Russell 2000, worth paying attention to, at least on the bullish side of the coin at this moment in time, if you want to take bullish trades, right? Some of you might be quite hesitant to take bullish trades moving forward because you feel like we're in the midst of a bear market, and while maybe you'll get lucky and have a couple of good bullish trades here or there, maybe you don't want to test your luck because you know that in a bearish tape, any bullish types of trades that you're doing have a higher chance of failing than when you are in a more bullish tape. But for those of you that are brave and you're looking for some of those counter trend types of moves, then perhaps there in the small cap universe can kind of get you done a bit more. In terms of the movements of all of these other charts, be aware that all of them still have a falling 30-day moving average and prices below that falling moving average. So that has not changed in recent days, even though the posture on the Russell 2000 has. So the S&P 500 was down 0.58%. The Dow was the day's worst performer. Now that they're kind of gunning for the higher quality names here in the last couple of sessions, it was down 0.75%. NASDAQ Composite was not quite as strong as what we saw at the Russell 2000. Nonetheless, it was down just 0.26%. I think that's worth mentioning as well, and something that I've been noticing myself with the markets here in the last few days. Remember, I think it was 1 week ago, we had the conversation about ARK Invest and the conversation about the bugs that were going to the zapper, and I was pointing out how the ARK flagship fund came within $2 of taking out the lows from 2020, but then had bounced, and it could be an interesting kind of counter trend, almost swing trade if you were to put your stop loss below the prior low back in 2020. Well, that phenomenon has continued. So if I were to look at ARKK, so ARKK is the ticker symbol, and let me right click on the chart and maximize this so you guys can see this a little bit better, ARK actually performed pretty well today. It was up 4.5%. Now, again, that needs to be taken in context because this is a fund that is down 60% in the last year, dramatically worse than what we see in the S&P 500 and the NASDAQ Composite. So, as we always say, the things that have gotten beaten up the worst have the greatest capacity to snap back the fastest. But it doesn't necessarily mean that all of a sudden we're going to be out of a downtrend. It just simply means things can get overdone on the downside. But it is worth pointing out that you have basically held the line here on ARK-K for the last week. And here's that blue line, by the way, that I was talking about. I must have left it on my chart from our conversation last week. So if I were to go back, let's see, we would need a 3-year chart here. Just to catch everybody up to speed in case you didn't listen to my presentation last week. This is what I was referencing. That blue line basically stretches back to this low on ARK-K back here at exactly 33 bucks. And last week I was saying how we came within $2 of tripping that, but then we caught a bit of a bounce. And so if you put your stop loss below the low over here, you might have a reasonable bounce opportunity from there. Now, you had to be brave. Again, these are not the trades for the faint of heart, because more times than not, you try to be a hero in a market like this and you're just going to get run over. But in this particular case, that would have worked out pretty nicely, because after hitting a low last week of $35.10, we're now up at $43.03. So we've just bounced $8 per share on this ETF. And remember, that is no small thing, right? If you were to take $8, divide it by 35 bucks where it was trading last week, we're talking about an ETF that is just ripped higher by its own, quote unquote bull market, as the media would call it. Oh, it's up 22%. It must be in a bull market. And you look at this chart and you're like, I don't think so. So it is up 22% from its lows last week. So obviously that's a very, very strong move. And that's perhaps another one of those elements that you could put in the interesting, not necessarily game-changing, but interesting phenomenons of where you're looking for turns in the market. Remember when I was with you on Tuesday, we looked at the sector selector tool, and I was pointing out, in fact, maybe we can go over there right now so that way I can catch those of you up to speed who were not with us on Tuesday, but sector selector, hang on just a sec. I was pointing out one interesting element of the sector selector rankings on Tuesday, and that was that information technology had bumped up a couple of positions. And this is actually the highest placement of information technology in the last 3 months. You can see that this bright green color here was never higher than this over the preceding week. So this is a 3-month rolling graphic here. Prior to that, the highest it had been was the 9th ranking. So now it made its way up to 8th. Now, we don't want to make too much of that, right? We're still in the lower half of the rankings, but it was different. And that's why I pointed it out to you. There is some change afoot. And when we go forward this week, knowing what I know now, I wouldn't have known this on Tuesday when I was with you, but knowing what I know now, I would say there's a pretty decent chance that consumer staples will not be number 2 when I redo these rankings tomorrow night. So be on the lookout for that. If you're a premium member, remember I always send it out via Telegram in case you're curious about that sort of information over the weekend. But I would put that in kind of that same category, because the way that you think about tech stocks is somewhat the same that you think about ARK Invest innovative types of companies, right? They're not one and the same. ARK Invest is definitely more hypercharged both to the upside and the downside. Nonetheless, it is at least one way to kind of consider things at this moment in time, that we are starting to get a few little green shoots here and there. So I thought that was kind of interesting here today as well. Not only did the NASDAQ outperform the S&P 500, but the ARK wildly outperformed the NASDAQ Composite, and the ARK was up 4% here today. And of course, they got a lot of work to do. But hey, at least there's some signs of life there, right? All right. That, I think, kind of wraps up my thoughts there on the old 4 grid. since we're over here on the internet, let's get this out of the way. I always like to say thank you to those of you that help support these presentations. And the last time I did the video, 105 of you clicked like, which is why I'm doing another full-length video for you at this moment in time. Remember, if you prefer the longer form videos where I give you a trade application example and go through more charts, then you'll want to click like for me there on Twitter. If you prefer a shortened 15-minute version where we only look at the 4 major U.S. equity indices, then don't click like. And if we're under 100 likes, then on those days I'll do just a 15-minute version. But assuming you like the longer versions, make sure you take the 5 seconds out of your day and trade it in for the 3 hours that it takes David and I to do these videos. And by the way, great job liking David's video last night as well. He did get up over 100 likes on his video, and he's, as I mentioned before, just does a phenomenal job during these really tough markets that we found ourselves in here lately. So I know I'm a little bit more direct with my request to have you guys like these videos, but please do that for David as well. He's a remarkable talent when it comes to his technical analysis. So thank you to all 105 of you that stepped up for us here the last time around. Now, earlier today, I did teach my question and answer session. It was another doozy, as you can imagine, 3.5 hours long. Whenever we get into more difficult markets like this, we get more questions from students, and gives us an opportunity to clarify our thoughts and provide interesting tidbits and explain to our students where we're interested in investing our money and different things like that. So that has been posted. David taught his ETFs class earlier today as well. That is also posted. So remember, you just click on the Trading Rooms tab to find those class recordings if you're a premium member. Tomorrow, David will be back in action with his very popular technical analysis class at 1 p.m. Eastern Time. So if you've ever wanted to be taught by a chartered market technician, every Friday at 1 p.m. Eastern Time is your opportunity to do that from David. Also, while we're over here, let's take a look at our factor selector. I'm not going to spend a lot of time on this here tonight because there really wasn't any change, so there's not much I can address. Now, this is as of Tuesday night's close, so it would not have included any impact from yesterday's trading or today's trading. So maybe there would have been some change had we included the last couple of days. But I always get this generated on Tuesday night in preparation for my class on Wednesday morning. So we kind of look at it after the fact here in this market outlook video. Nonetheless, gives us a general sense as to what we are seeing from a factor perspective. And right now, a lot of those same kinds of themes are holding true, where we've got dividend yield still holding the line up at the top, and we've got momentum factor still struggling at the bottom. But again, with what we saw today, if I were looking at this on a one-day basis, there without a doubt would have been a little bit of damage done to the dividend yield and a little bit of an improvement from the momentum. The question is whether there was enough change here today and yesterday to actually have a overall ranking change when I redo this graphic next week. Because remember, there's 3 different time periods worth of strength and weakness that are going into the rankings: 1 month, 3 month, and 6 months. So what happens in a 2-day period isn't necessarily going to change the rankings. But if it's a violent enough move, and there has been a pretty violent move in the last couple days, so it's entirely possible, then there is that possibility, because of course the last 2 days are part of the last month and 3 months and 6 months. So we'll all find that out a week from right now. But right now we do still kind of have those same themes holding true, with the more mundane capital preservation areas doing well on a relative basis up at the top, and the more speculative areas still struggling to keep up on the bottom. Let's get back on over to the charts now and do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And a reminder that when the background colors are green, that means we have a bullish posture using the market forecast technical indicator. When the background colors are pink, it means we have a bearish posture using the market forecast technical indicator, and specifically the intermediate line. And so, as you can see, things have changed a little bit, right? When we were together on Tuesday and we reviewed this, at that time, we had just 2 green charts, and those 2 were the US dollar in the lower left-hand corner, and then oil here on the bottom rung. Today, you see we now have 3 green charts. Oil stays with a strongly bullish posture, just like it was 2 days ago. So that's not all that new. Oil was up 1.63% today and remains above that rising moving average as well. So there is at least a semblance of a bullish trend still in place in the commodity of oil. But what is different up at the top here is that the foreign stocks all of a sudden have found themselves in a weekly bullish posture. That's not a strongly bullish posture, but a weekly bullish posture. So we don't want to get ahead of ourselves here, right? If you were to look at this oil chart down below and then compare it to EFA and EEM up at the top, I think it's pretty clear which of those charts looks better at this time. But doesn't mean that things can't change. Obviously they will at some point. It's just a matter of when and how quickly you recognize that change. So when we're looking at those two charts up at the top, remember, EFA represents the developed foreign stocks. So think of Europe, Australia, Japan, etc. EEM represents the emerging markets in the foreign world. Think of China and Russia and Brazil and India, Mexico, that sort of thing. So you can see that both of them were up today on a day when the S&P 500 was down. That's kind of noteworthy, right? As I mentioned on Tuesday, China has become a little bit, has loosened its grip a little bit on its coronavirus lockdown that they've been grappling with here lately. And I think that's kind of added a little bit more enthusiasm to some of those emerging market stocks. But another big story from my perspective is the US dollar, which was once strongly bullish, has now sold off 4 out of the last 5 days ever since getting those overbought cluster signals. Remember, those two little red dots right there tell us that on those 2 days, we got our first overbought cluster signals, in the last, several months. And so maybe we shouldn't be surprised that after getting those overbought cluster signals, we immediately saw a 4 out of 5 day downdraft there. And that has then given a slight boost to foreign stocks. Remember, when the US dollar is weak, all else being equal, it will help foreign stocks more than it will US stocks. Now, keep in mind, it's not quite as clean cut as that because a lot of US stocks are like McDonald's or Procter & Gamble or those types of companies that are truly international enterprises. But nonetheless, it's at least a high-level way to think about the markets. And so the question is, where do we go from here? And are these new changes in postures going to hold? Now, I think for those of you that have been listening to my analysis closely enough over the years, you probably are quite well aware of where my mind is right now. And my mind right now is that I will believe it when I see it. So, in other words, I'm not willing to trust the posture change yet. In other words, yes, it's nice to see that we've got a nice reversion to the mean type of a move on EFA and EEM after having those oversold cluster signals. We're starting to catch that, dead cat bounce right there. And likewise, we've reverted to the mean on the US dollar after overbought conditions. So remember, red dots are the exact opposite of the green dots. So we got too overheated to the upside on the dollar, which means we needed to pull back. We got too overheated to the downside on foreign stocks, which means we needed to revert back up. And so right now, when I'm looking at those moving averages, I still see a lot of bearishness in those foreign markets. And so all else being equal, I still am going to be a little bit cautious around those foreign stocks, despite them finally getting back into the bullish territory. And likewise, I'm still going to give the US dollar the benefit of the doubt. Yes, it's down 4 out of the last 5 days and now has that weekly bearish posture, but it remains above its rising 30-day moving average. And after having this epic move like it did, I would say any chart needs a chance to cool off. This is a cool off period. Doesn't necessarily mean it has to be trend changing. So let's keep our eyes on some of those themes there. There is a potential for a reversal, but again, I think we're just a little bit too early in the move to claim that it is that we're actually going to see a legitimate change where foreign stocks all of a sudden are going to erupt to the upside and the dollar is just going to collapse to the downside. I'm not in that mindset quite yet. Now, another one of the big hot button stories here more recently has been what's going on with interest rates. We did see interest rates fall again today. Notice that we are back down to 2.85% on the 10-year Treasury. yield, right? And so the bond prices themselves were up a bit here today. So notice that TLT now finds itself just on the underside of that falling 30-day moving average, and TNX is basically sitting on its 30-day moving average, basically a little bit below it. You can see that that is something new to report to you. The tip of that moving average, so if I were to right-click on it, maximize it so you can see this a little bit better, is yellow. Yesterday it was green. What does that mean? Well, it means that we closed below the rising moving average in this case. If we continue to trade below the moving average long enough, that moving average will eventually bend lower, and at that time would turn into a red moving average. But until then, you kind of want to be able to give it a little bit of breathing room. Maybe it just needs to work out its issues. But I think it's at least worth pointing out, since it's something that is new that we have not seen, by the way, since March 8th. That was the last time we had a yellow moving average. Between March 8th and here yesterday on May 18th, we have had nothing but green moving average. So this has become a little bit more strained here. In fact, I wouldn't blame you if you said, well, this is starting to look like it has the potential for a head and shoulders pattern, with this being a left shoulder, that being the head, and perhaps we're forming the right shoulder right now. That would be quite interesting. I'm not necessarily sure that would be bullish. It feels to me like the tune of the market has changed quite considerably in the last month or two. Remember, there was a time that when the TNX would fall, it would positively benefit a lot of tech stocks. And when TNX would rise, in other words, interest rates would go up, it would do considerable damage to the tech stocks. What we're seeing here more recently kind of feels a little bit different, almost as though market participants are moving some of their stock allocation into bonds because they're getting scared of taking risk. And if that's the case, of course, that's not the best of signs for the stock market either. Now, that can be taken to an extreme, and eventually that can get unwound the opposite direction as well. But in the early infancy of that, if you're just starting to now see investors moving into government bonds because they're fearful of what might happen in the stock market, then there's a lot of people that think that the bond market is smarter than the stock market. And so that could very well be interpreted poorly for stock participants moving forward as well. So that's another story I want to kind of keep my eye on as we move forward here in coming months. All right, let's go ahead and now take a look at our sectors. And this will be chart 5C. So as we pull up our sectors here, it's quite a mixed bag. And I would say the most eye-catching situation to me, now again, keep in mind where I come from with this conversation, knowing what you know about my personal portfolio, but the staples certainly catch my eye. I've certainly felt it in the last couple of days, I can assure you of that. But the staples have completely just nosedived here. And it really feels like it was Target that did that yesterday. And it kind of was a wake-up call to the dividend growth community, as it were. Like, hey, if they can take Target out and just lop off 1/4 of its entire value, they can do it to anybody. And all the other aristocrats. Remember, Target is a dividend aristocrat alongside many other companies, including staples. Technically, Target is a discretionary stock, but its direct competitor, Walmart, is a consumer staple, as is Coke, as is Kimberly-Clark, as is Clorox, as is Pepsi and Procter & Gamble and Colgate. There's a ton of really, really high caliber dividend aristocrat consumer staples. So once the wake-up call happened yesterday and the alarm was sounded to let the world at large know that, hey, we're coming for the aristocrats now, it feels like there was a mass exodus from some of those names. And like I was mentioning to you guys a few weeks ago regarding the staples, I've been very clear on the point that the consumer staples previously were benefiting from their defensive characteristics, but I was also telling you that I personally did not view them as being cheap or value investments. In fact, A lot of the like Coca-Colas and Pepsis of the world were being valued at the same rate as high growth stocks like Google and Facebook and some of those types of companies, which doesn't really make sense, right? The market is not always going to get it right in the short term, but in general, if a stock has huge growth prospects in the future, traditionally it deserves a higher PE ratio. But what we saw here in the last couple of months is that those staples with slow growth rates were commanding higher PE ratios because investors at large wanted to hunker down in those areas while there was so much carnage developing elsewhere. Well, they came for all of them, and they finally got even the so-called safe stocks here in the last couple of days of the consumer staples. So that chart all of a sudden looks absolutely terrible. In terms of some of the other charts, things are looking quite a bit better in other areas. You will see that there are 4 bullish charts on the graphic here. Remember when I was with you on Tuesday? Now remember, that would have been on this day of the consumer staples, so I would have had no knowledge about that wipeout right there yesterday and then the continued fall today. But at that time, 2 days ago, consumer staples actually had a weekly bullish posture and healthcare did not. So those two have flip-flopped in the last 2 days. Healthcare now has a weekly bullish posture, joining utilities and materials, which continue to have those weekly bullish postures, just as they did when I was with you on Tuesday. And also energy remains in a strongly bullish posture. One thing that's kind of interesting about energy is energy stocks, right here in the form of XLE, were actually down today. So they sold off today despite oil prices on a per barrel basis going up today. So that's kind of interesting. However, there wasn't much damage done here on this chart, and so we still retain that strongly bullish posture. Obviously, this is still an uptrend, even though we sold off the last couple of days. We're still above the rising 30-day moving average in that case there as well. So, it's still the same thing that I mentioned to you on Tuesday, and I probably mentioned to you dozens of times in calendar year 2022. This is energy's world, and everybody else is just living in it, right? This is the only moderately good-looking trend that exists from a sector perspective. They remain the only sector that is trading above their 30-day moving average. Not only that, but their 30-day moving average is still rising. Notice that on all of the other charts, the moving average tip is red, meaning that price is currently below falling 30-day moving averages on all 10 of the other sectors out there. The only exception to that is energy. There are some people that feel like before this washout is complete on the downside, they're going to have to take out the oil and gas stocks as well. That is certainly possible. Remember, that is how things played out back in 2008 and 2009. At that time, in the lead up to that great financial crisis, we did see oil prices go all the way up to $150 a barrel, and many oil and gas stocks did quite well during that era. But then when the actual economic recession kind of set its hooks, so to speak, it did eventually just crater the oil and gas stocks as well. Whether we have an exact replica of that playbook this time around remains to be seen, but that is something that is floating around out there in the ether, and I thought I would share it with you here as well. We don't want to jump the gun on that philosophy because that can come with heartache, right? Everybody who has jumped the gun on the idea that energy stocks need to go down, they likely regret that decision. In the last 3 months, we've had plenty of pullbacks. And if everybody thought that was the time when they were going to start cratering, they were dead wrong because we've just continued to go up to new highs on energy. So you got to kind of wait for, the evidence to start, more obviously showing itself on the chart. And we're just not really seeing that yet on energy. So will that happen maybe later this summer or late this year or early next year? And will that be the final nail in the coffin until we go into a legitimate recession and bear market? Perhaps. But right now, you kind of have to trust that these trends will hold because there still could be some good meat on the bone on the trend that exists here on energy, because I think a lot of people are still underexposed to that particular sector. So anyway, it was a bit of a mixed bag here in the sectors today. The biggest performer on a one-day basis today was materials. They were up 0.71%. And then our worst performer here today would have been the aforementioned consumer staples. They were down 1.78% today. So let's go ahead and get into our trade application example now. And I'm going to pull up our swing trading chart, chart 3A. And I'm going to pull up a company that, for those of you that have followed me on Twitter over the years or who have been in my dividend classes, either here at Market Scholars or with my prior company at TD Ameritrade, you'll know this ticker symbol because it is one that I am fond of from a long-term perspective. And that is ABV. That's ticker symbol ABBV. They are similar to Target and all the rest of those that I rattled off earlier, an aristocrat. Now, this one's a unique aristocrat because technically it hasn't actually existed as a standalone basis for the 25 years that are required for a dividend increase to make it on the aristocrat list. But they gained special allowance, I guess you would say, from Standard & Poor's, the committee in charge of putting that aristocrat list together. And the reason behind that is they were spun off from Abbott Labs about a decade or so ago. And so because a lot of the dividend paying power went to the pharmaceutical unit that was spun off here with AbbVie, the committee and the powers that be did allow them to retain the aristocrat status even as a separate standalone company. So a little bit of a unique background there. And that has nothing to do with the trade here, but just trying to share that education with you nonetheless. So point is, AbbVie is a company that we have a long history with. In fact, when we were at TD Ameritrade in my dividend classes, our earliest purchases of AbbVie were under $60 per share. So naturally, we couldn't be more thrilled to see how well we've done with that investment over time. What makes it particularly unique is that not only has the price done incredibly well, but the entire time of this move, where it's been more than a double, it has had an above average dividend yield. So for folks like myself who do dividend reinvestment, it's even much more dramatic total return gains than might be appearing just off the surface there. So my disclosure is I do like AbbVie as a long-term investment. However, this market outlook video that David and I present to you here is not dedicated to long-term investors, for better or for worse. This kind of falls into David's camp a bit more. I'm more of a long-term investor, but this particular free video that we have here on the market outlook video on YouTube is dedicated to those of you who are a bit more active in your trading. Remember, for those of you that like the long-term approach and want to get my insight there, of course, I teach a couple of classes here at Market Scholars that does concentrate on the long side of the market. So I'm happy to teach that. In fact, that's my passion. It's just that is not the goal of this particular market outlook free video that we put on YouTube. So in this video, I kind of have to wear a slightly different hat. And although I'm thrilled to see the success that AbbVie has had over the years, I can also see with my own two eyes that if I'm truly honest with myself and I want to remain objective with my analysis, that it appears that AbbVie has started to roll over underneath its falling 30-day moving average. So that's not really a great look in the short term. The other thing that I would kind of add to this conversation, let me just switch gears here for just a second. I'm going to go over to my dividend stair-step chart that I use for my long-term classes. And I'm going to pull up ticker symbol AbbVie or ABBV. And as I pull that up here, you can see that earlier this year, when AbbVie went all the way up to $175, it got into this orange territory on the dividend stair-step chart. That's what we as long-term investors perceive as overvalued territory. We perceive the blue zone as undervalued and the orange zone as overvalued. So as you can see, where we stand right now is still closer to the overvalued zone, even though it's now fallen out of that overvalued zone in the most recent few weeks. Nonetheless, we are still a long, long ways away from being comfortable with putting a brand new bullish trade on for the long term here. It would have to fall all the way down here to 110 before we would be comfortable doing that again. So we're happy for all the times we bought it previously, but things change as time goes on. So point that I'm trying to make is this one is probably leaning closer to the overvalued side of the equation, which kind of assists us when we are starting to think about bearish trades in the short term as well. It's maybe just one more piece of evidence. Now, one thing that I don't necessarily love about this bearish setup is that it is still outperforming the S&P 500, if you can believe it. So the S&P 500 dotted line is down below, and while AbbVie's chart does not look great right now, it has still outperformed the S&P 500 over the last 3 months. AbbVie is still up about 5% over that time period. whereas the S&P 500 is down significantly. So, that's maybe not ideal in this situation. But you have to remind yourself that in my portfolio right now for this presentation, we have way more bullish trades than bearish trades. So I'm always looking for opportunities to kind of balance the scales a little bit. This is kind of a tricky time for me because if I'm honest with you, I think that we're due for a bullish move higher in the overall indices. So looking at something like the S&P 500 here, you've heard me talk about in recent presentations, I'd like to see the S&P 500 get back up here to that falling 30-day moving average, and I do think it's possible to do in a fairly short amount of time, in just a week or two that could happen. And so I'm kind of stuck in this weird mindset right now where I recognize the trends are clearly bearish and the posture is clearly bearish. But I also think that you can take that too far, and if you stretch that rubber band too far, there can be a snapback rally. So I kind of am, in this constant debate in my own head as to how to handle that situation. And right now, the truth of the matter is, I've got enough other bullish trades with all of our sold puts and all of that to at least help me feel satisfied if we do get some sort of an epic move higher for the S&P 500 in coming weeks. On the flip side, if we don't get that and the trend holds and we don't get any sort of a washout, big VIX spike type of a day, and we just keep on doing the death by 1,000 paper cuts thing, then I think it would be helpful to have some bearish trades on our books as well. And remember, I do have a bear call spread on Texas Instruments right now as well. And that's what I did here with AbbVie. Basically, I sold, I think it was the July 160, 165 bear call spread, and we got that 30% return on risk. Remember, for those of you that are premium members, we send out the screenshots and the trade details and the executions and all that via our Telegram app, so you can always stay tuned to that. But basically what that means for those of you that are less familiar with options trading is I'm basically hoping that this stock stays below, let's call it 160, 130, or somewhere in that general vicinity. So if 160 was my sold strike, then I would add the credit that I received for that as well. So it might have been like $1.20 or something like that I got here today. So somewhere around 61.20 to 61.30 would be where I do not want AbbVie to go. If it goes sideways, I'm comfortable with that. If it goes up, but it just doesn't go up above 161, I'm reasonably comfortable with that as well. I'm obviously feeling really good if it just rolls over, because the further away you get from 161, the more likely it is that you're going to make profits on it. But if it goes above 161, that is where I would lose that trade. Now, when we look at this chart, you'll see that it's trading below its falling 30-day moving average here. It has a bearish near-term posture. That's what the pink background color is telling us, that this blue near-term line is now out of favor. You also have the green line at 37 and falling, telling us that we have a weekly bearish posture. Actually, I take that back, a strongly bearish posture using the intermediate line, in addition to what we're looking at on this chart from the short term with the near term line. In addition to that, it does appear that this one has what's known as a bearish near-term divergence signal, where we've got a peak in the near-term line there in blue here on the 4th of May, and then we've got a follow-up peak here on the 13th of May. Obviously, that second peak is well below the first peak, yet when we look at the price candles associated with those two levels, here's candle number 1, and then here's candle number 2. Candle number 2's price is higher than candle number 1. So in other words, price went up at a time when the technical indicator is saying there's something a little bit wrong or suspicious with this particular setup. There's something a little bit negative once you look under the hood a little bit there. Now, whether that's enough to actually keep this bearish or not is anybody's guess, but it at least is one reason or excuse that you might, give yourself to take a bearish trade here or there to balance out the scales of the bullish trades that you might have in your portfolio without getting too aggressive on things, right? You can kind of take that concept a little bit too far as well. In this case, we're not expecting the world out of this trade. We just need it to kind of stay flattish here in the next couple of months. Also, a quick little reminder before we close up here tonight. Tomorrow is options expiration date, so make sure you're babysitting your positions. In fact, after Tuesday's close, when I was telling you that everything looked to be in good shape, one of our contracts did start falling out of favor, and that was Best Buy. Like a lot of retailers, it got crushed yesterday following the Target news, so there was nothing specific with Best Buy. It was just down in sympathy with other brick and mortar retailers. And so Best Buy did go below its strike price of the sold put that I had sold. And again, for those of you that are premium members, you should have seen yesterday that I did send out the notice that I did roll those contracts. So we rolled them from the $80 level, I believe, to the $75 level. And we actually got a very nice credit for doing that. We took in a credit of $1.30. So that one did not go the way that we wanted to, but the trade's not done yet. We will continue to monitor that trade, but all of our other trades that we had with an expiration date of May will roll off the books tomorrow, in all likelihood at max gain. Obviously, if that changes, I'll let you know in the Telegram app, but right now we're in reasonably good shape other than Best Buy, which I did end up rolling at a very, very favorable credit, and we'll continue to keep that one on the books, so to speak, for one more month to see how things shake out there. Okay, so that's what I had for you here tonight. I appreciate you checking out these videos. Remember, if you appreciate the 3 hours that I put into preparing this for you and producing it and editing it and sending out the notifications, all that good stuff, I ask one simple request out of you. Just simply click like for me there on Twitter. So as long as we're up and over 100 likes, I'll be happy to do another full-length video for you on Tuesday. But until then, have a great weekend. Enjoy your day tomorrow. Best of success with your trades and your investments. Goodbye for now.